The top 1% navigate a financial ecosystem that operates far beyond the reach of traditional retirement accounts and index funds. The wealthy treat passports as financial instruments. By relocating to jurisdictions like Dubai, they drop their capital gains taxes from nearly 24% to zero, turning a change in address into a hedge against high taxes. Malta serves a similar purpose in Europe, offering an established infrastructure designed specifically for tax elimination. This diagram shows the mechanics of an infinite return. Investors refinance distressed properties to extract their initial capital tax-free while maintaining full ownership. Any cash flow generated from that point forward is profit made with none of the investor's own money left in the deal. Building wealth at this level begins by restructuring personal geography and asset leverage to remove tax liabilities from the equation before any growth even occurs. We can see the multiplier effect in action here. By buying and combining fragmented service businesses like pool cleaning or HVAC under one logo, investors create a single entity that commands a much higher valuation multiplier than any standalone shop. This flowchart outlines captive insurance. Operating businesses pay deductible premiums into a private, self-owned captive company. Those tax-deferred reserves are then used to invest in real estate, stocks, or even other people's life settlements. Instead of buying a fund, the wealthy buy all 500 underlying stocks individually. They sell specific underperforming stocks to harvest tax losses, offsetting other capital gains. They immediately replace those shares with similar assets, keeping the tax write-off without losing index exposure. These investors don't passively accept market rules. They construct custom corporate entities to dictate their own valuations and tax deductions. The most successful energy investors focus on the flow. By owning the pipelines, storage, and trade contracts, they collect a guaranteed toll on every drop of fuel that moves, regardless of the fluctuating market price of oil. Fine art offers similar advantages. Storing a Picasso in a Geneva free port avoids sales tax, while using that same art as collateral for a bank loan allows the owner to access millions in tax-free cash at rock-bottom interest rates. This chart tracks the returns of litigation finance. While the standard market index crashes in the background, these specialty funds finance massive lawsuits in exchange for up to 50% of the eventual settlement, securing a profit that ignores economic downturns. Overfunded whole life insurance policies act as private banks. The wealthy borrow against their own cash value tax-free to fund other investments, all while the underlying policy continues to compound. Financial security at the highest levels relies on acquiring assets that generate returns regardless of whether the broader global economy is expanding or contracting. IK and royalties provide a constant stream of passive income. Every time a song streams, a film is syndicated, or a pharmaceutical patent is used, a percentage of that consumption flows directly to the rights holder. This equation breaks down the mechanics of tax liens. By paying off someone else's overdue property taxes, investors earn state-guaranteed interest of up to 36%. If the homeowner defaults, the investor forecloses and acquires the property for a fraction of its market value. These vehicles function just like mandatory toll booths. By acquiring the rights to other people's daily consumption and legal obligations, the elite create a yield that is structurally insulated from market speculation. The U.S. government acts as a direct deposit tenant through the Section 8 program. Investors buy lower-cost properties and receive the rent directly from the Treasury every month, creating an unshakable, recession-proof income stream. While retail investors wait for the hype of a public IPO, the elite gain access much earlier. This growth curve shows why the timing matters. Massive 100x growth occurs almost entirely during the private phase. By the time a company reaches the public exchange, much of that generational wealth has already been extracted. In this system, the public stock market often serves as an exit liquidity trap for those who weren't allowed to buy in before the ticker symbol existed. This scale illustrates the roster depreciation allowance in sports team ownership. This provision lets owners write off the declining paper value of their human players against their personal income, often wiping out millions in federal taxes while the franchise value skyrockets. GP stakes take this a step further. Instead of just investing in a fund, the ultra-rich buy a percentage of the private equity firm itself. This guarantees them a share of the management fees on every dollar the firm manages, regardless of fund performance. Champion racehorses represent another unique asset class. Syndicated shares in these horses can generate up to $500,000 every time the horse successfully breeds, resulting in tens of millions in cash flow over the horse's career. Building real wealth requires a move away from traditional retail advice toward the asymmetrical strategies used by the 1%. To build a legacy that is truly unbreakable, you have to stop playing the game and start owning the league. Hit subscribe now to get the blueprint.